Welcome to another episode of Real Estate Investing Explained. Here's today's question. So what do you look for in a property to potentially house hack?
If it's a house, I usually recommend getting a home that's 2 stories, 4 bedrooms, so that you can live in the master and rent out the other 3 bedrooms. And the reason why I say 2 stories is because 2-story homes usually have at least 2.5 bathrooms. So while one of the roommates is taking a shower upstairs, the other roommate can go downstairs and use the restroom there. And I usually recommend getting a home that's, if it's a single family home, at least 1,800 square feet so that the bedrooms can be large enough for a queen bed. I've done this multiple times. So I know, like, when I walk into a house, I can already tell if it's going to be a good layout for house hacking or if it's not going to be a good layout. And then there's multiple strategies depending on how the buyer, how the investor wants to invest, from the perspective of, I want to buy a new home that's remodeled or that's brand new, and I can put the ads on Craigslist or on Facebook, whatever, and find roommates. But if it's a brand new home, it's going to rent out quick. If it's a home that needs rehab, like if you're going to do the burst strategy where you're going to be buying it and rehabbing it and stuff like that, it might take a little while for you to build that passive income. So it all depends on your strategy, because if you're handy and you already know how to remodel a kitchen or change out the floors, paint, awesome. I don't know anything on like the handyman contracting side. I can sell you homes, but I do not know how to rehab anything. So I'm the kind of person that just gets rehabbed, like remodel or brand new homes, to house hack.
Yeah, and that's a good point, because I know when I first got started in real estate, that was one of the first limiting beliefs that I had. I didn't think that I could be involved in real estate. 1, because I didn't think I had enough money. I thought it was only for rich people. And 2, I'm probably one of the least handy people you'll ever meet. So I didn't think I was able to be a real estate investor. I thought we had to be able to do the work ourselves. And I quickly learned that those 2 limiting beliefs were not true. From what you talked about, the house hacking strategy, where you only need to put 0 to 5% down, and then you don't need to be a contractor to buy investment properties.
Exactly. And the benefit of also starting with house hacking is that you can live in that house, right? Now that you're living for free, if you were able to save $10,000 in 1 year while you lived in your apartment or whatever, and now you're living for free, you can save probably double that for year 2. And then you can move out of your first property and repeat the process again on your second property. And that's how you're able to snowball this process, because you can get a home every year or every 2 years using the owner-occupant loans. Now, quick tip here too is I usually recommend getting a conventional loan that's 3 to 5% down if you're buying a single family home. But if you're getting a multifamily, I always recommend getting an FHA loan, because they account for the income from the sides, or the one side. If you're getting a duplex, they account for that so that you can qualify for that amount as your income, and you can buy one by putting down 3.5% down.
So why that dynamic there? Why the distinction of conventional for a single family and FHA for the multifamily? Does multifamily conventional not consider the income from the other units?
Yes, conventional on the multifamily, they don't consider the income. And if you're going to be living in the property, they require you to have 15% down. So it makes it like super hard, right? Because here, like if you're buying a $300,000 duplex, you go from needing $9K or $11K down to needing like $30K or like $40K to be able to buy that property.
Yeah, I mean, at that point, it's a little better than a traditional investment loan, but it's really not that much better. I mean, 15 to 20% is not a big discrepancy there. You're not getting that major benefit of being an owner occupant.
So if you do have the cash, sure. But because with FHA loan, the PMI stays on the loan, stays with you for the duration of the loan. So you have to consider that, which is why I always tell people, it's like in a multifamily, it's not a big deal. But on a single family home, conventional loans are always better. The benefit of, even if you do want to get a multifamily with a conventional loan, is that you do get the owner occupant interest rate. So for example, right now, as of December 2019, and it's super important that we say the dates in these things because interest rates change quick. Right now, for an owner occupant, you're looking at a 4% for a single family home. But if you're an investor, you're looking at like 5%. And I'm giving you rough numbers, right? Because like I helped 2 people buy a home this month and their interest rate was 3.6. So just as a rule of thumb, is usually 1% lower for an owner occupant than an investor.
That's all for this episode of Real Estate Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.